The stock market is going crazy. We have airlines popping 9% again, cruise lines popping 8% again, and our beloved growth stocks dropping over 35%. What is happening? Why is it happening? And what should you consider doing with your portfolio coming up next? Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we are talking all things rotations. Recently, you've probably noticed that the market has ended some days looking like this, or like this, where the Dow crushes it, the Nasdaq lags in the red, and the S&P is along for the ride up. This is what's commonly referred to as the rotation of investors' money from a certain area or sector in the market to another area or sector, in this case, from tech and high growth stocks to value, cyclical, and Rona stocks. And this isn't the first time the market has done this in the past few months. This is a video from my Instagram pointing out the rotation from Rona stocks to FANG and tech stocks over 8 weeks ago, when Apple was still at $344 and Amazon was still at $2,600. And this past week, our Discord community was all over it, calling out the potential start of this rotation back on Friday, August 7th. Then on Saturday, our man Kevin D shed some light with some charts detailing the beginning of this potential rotation. Then on Sunday, me talking about making this exact video on Sunday night, August 9th. Of course, if you'd like to join our Discord community of like-minded investors, it's the first link in the description below. Now, by the time this video comes out, the rotation may already be over for the most part, because sometimes they don't last that long. However, I see several more of these rotations happening in the future in the stock market, and everything I'm about to talk about in this video will not only help you prepare for and potentially identify a rotation, but also how maybe you could take advantage of one next time. Give me the format. First, what this rotation means and what might be causing it. We do some serious deep dive examples here. Second, why my portfolio, despite being 60% growth in tech stocks, wasn't really heavily affected by the huge drop in stocks like Livongo, down over 19%, and CrowdStrike, down over 15% in the past few days. And finally, third, what I would personally do if I were to start a portfolio today. Let's get started with part one, what this rotation means and what might be causing it. To put it simply, I see it as investors taking profits on growth and tech stocks that have outperformed over the past couple of months, and they're finding new opportunities in undervalued or neglected stocks like banks, airlines, industrials, etc. And you might be thinking,
but Matt, why now? Tech only benefits from the Rona.
Well, yeah, and you forgot the golden rule. Stonks only go up. Jay Pow Pow has our back. Okay, but seriously, why now? That's a great question, and here is my theory. Earnings season. I've got 4 words for you, and 2 of them are the same. Earnings run-ups, run-ups is a hyphenated one word, and earnings expectations. Let me explain with some digestible examples. We need to lay out some groundwork to build my case, so buckle in. Let's take 2 very popular high-growth stocks that have seen impressive growth since the recent March lows, AYX and Datadog. Prior to their post-earnings drop, AYX was up over 113% since the recent lows, and Datadog was up over 200%. And that is just insane in any other regular market conditions, but surprisingly, that is not very uncommon nowadays to see 100, 200, 300% gainers since the March lows. So keep this big picture in mind, and now let's look under the microscope. Stay with me here. AYX ran up 8.2% in just 6 trading days leading up to its earnings report on August 6th. That date is important, so keep it in mind. Datadog ran up 11% in the 8 trading days leading up to its earnings report also on August 6th. 8 and 11% gains are gains that I would be happy with if I were holding a stock for a few months, but to do it in 6 to 8 days like AYX and Datadog, on top of already running up over 100% since recent lows and 200% since recent lows, that is what is called priced to perfection. But then watch what happens. This is important. AYX beats on top and bottom line analyst estimates on their earnings, but their stock has tumbled over 38% since earnings. Why? Because they had weak future guidance. Even to just maintain their already insane valuations, AYX had to deliver incredible numbers and incredible guidance. But instead, they were just kind of like, so about that growth that you guys all priced in, we're just not really going to be able to deliver that. Our bad. And this is a reminder that earnings are not just about the EPS and the revenue. A huge part of earnings moves are forward guidance and their conference calls. We see the same thing with Datadog beating their earnings estimates, but their raised revenue guidance still wasn't good enough. Yep, Datadog literally raised their guidance to be ahead of what analysts expected their guidance to be, and their shares still dropped 19% in the following few days. So here's the punchline, here is my theory. Q2 earnings for the high growth, high flying, untested, relatively unknown prior to Rona stocks like AYX and Datadog. Their Q2 earnings exposed their valuations. This whole time, everyone is piling into tech and growth stocks because they're borrowing money at record low interest rates, and everyone needs tech nowadays now that we're working from home and in lockdown. So the stock prices and valuations just kept going up and up and up, and we didn't have any real numbers from these companies to keep our reality in check. But now with Q2 earnings, we have those numbers to tell us whether or not we were right for piling into these stocks continually for the past 2 months. And so far, the market thinks we were wrong. I actually think we'll see a little rebound into growth pretty quickly, but more on that later. But here's the kicker to my theory to answer why now. This rotation, in my opinion, was triggered by the earnings specifically of these high-flying growth tech stocks. You see, there really wasn't a rotation when the Big Four reported because Amazon, Apple, and Facebook absolutely shook analysts.
Christine. I am shooketh.
With earnings that 10x'd analyst estimates, Amazon pretty much did the impossible and justified their price to perfection. So did Apple, and I think personally Facebook was actually undervalued when it came to their earnings report anyway. But the high-flying stocks like AYX and Datadog triggered this rotation with their earnings reports because they were some of the first high-profile, unjustified, untested, and very expensive stocks to release their earnings reports. That's right, I think that their earnings reports on August 6th triggered this rotation, and you thought I wouldn't back it up with more evidence? Boom! CrowdStrike, another new high flyer, did not report Q2 earnings yet, but they started dropping right when Datadog and AYX peaked before their earnings and started dropping too. Oh, you want an example from a different sector that's not cloud? Boom! Mercado Libre runs up over 23% in the 8 trading days leading up to August 5th. Their earnings report doesn't come out until August 10th. But what do you know? Mercado Libre drops over 8% after Datadog and AYX peaked and continues to sell off after Datadog and AYX reported earnings on August 6th. So to top it all off, I give you a timeline. August 5th. Tech and growth stocks peak in anticipation for upcoming earnings. August 6th. Earnings reports for companies like Datadog and AYX and other high flyers come out and prove that their valuations are far too high. August 7th, the very next trading day, we get this screenshot of the market showing the early signs of the rotation. So in summary, my personal analysis is that this rotation was triggered by the Q2 earnings of the high flyers who were unproven and then thus proven to have too high a valuation. Then investors took their profits after having successful outperformance over the past 2 months and looked for new opportunities in neglected stocks that had not participated in the rally, more specifically in cyclicals and Rona affected stocks. That's what happened, that's why it happened, and that's why it happened then, in my personal opinion. Now let's move on to part 2, why my tech and growth heavy portfolio was actually able to take this hit pretty well. I've put about 55 to 60% of my total portfolio into growth and tech stocks because I have a very aggressive investing strategy. Reminder that you should only do what's best for your risk tolerance and, of course, in your financial best interest. The other 40% of my portfolio is split into ETFs, dividends, and most of that 40% is put into value plays. These are stocks that, simply put, I think are undervalued. As you can see here, for this day, my 3.5% gain in my value plays portfolio helps buffer the 2% haircut in my growth portfolio. My 2 biggest value plays right now are Cheesecake Factory, which I talked about several times on this channel. I'll link one of those videos right here. And the second one is Dan the Man or Dana Incorporated, and I'll link one of my videos on Dana right here. So despite this rotation definitely taking a temporary toll on my growth and tech stocks, since that critical August 5th date, Cake has risen over 9%, which is awesome, and Dan the Man has risen over 7%, actually gaining 8% today alone. So the balance of growth and tech and strong value plays and also ETFs and dividends is really how you can protect your portfolio from big moves in the market like this. And that brings us to the final part of this video. How would I build a portfolio if I was starting in the market today? I think you guys kind of get the idea. After part 2, it would be a split between growth and value with a little bit more towards growth. Personally, I think we'll see a pretty quick return to growth if it hasn't happened already by the time you're watching this video, so I would slowly start buying into some really strong, fundamentally sound growth stocks. The 60-40 weighting of growth versus value, dividends, and ETFs has worked pretty well for me so far, but remember, I'm intentionally aggressive with my strategy and I'm at a younger age, so I have more time to recover if I somehow take on too much risk. But the one thing I would change about my portfolio if I were starting from scratch is I'd probably give myself more exposure to Rona stocks like airlines, cruises, and restaurants, but actually maybe not so much cruises. So I would definitely just buy right back into Cake because I think that's the best of breed when it comes to restaurants and recovery stocks. Well, in my airlines video where I talked about why I wasn't buying into the airline rally back in June, which actually turned out to be a decent call, I said that if I were to get into airlines, I would be buying Southwest, ticker symbol LUV, because it has the best balance sheet by far and the least debt among other reasons. If any airline were to survive all of this, no matter how long it lasts, my bet would be on Southwest, and when it comes to airlines, my bet is on survivability, so that video on airlines will be linked right here. And the reason I didn't buy into the airline rally back in June was, one, it just seemed like there was way too much hype and froth during that time, and two, is opportunity cost. Back in June, we didn't have a great timeline of when it would look like we would get a functioning vaccine, and the TSA numbers for daily passengers was also still very, very low. So this means if I had bought airlines then, in my mind I was thinking, well, I might have to hold this for a long time and watch it flatline while everything else rises, because airlines probably won't do much until we see a lot of travel pick up and a vaccine. Now we're seeing a lot more positive news surrounding vaccines or potential cures, and once we find one that works, you better hope that you are on the airline boat if that's the play you're trying to get after. And also, we see TSA numbers are at their highs since lockdown, which is really positive. But this isn't an airline video, so I'll stop talking about it right there. And again, this is what I personally would do, but not necessarily what I am going to do. So that is what a rotation means. That is why I think it happened now. That is how you could potentially protect yourself from any future staggering rotations. And finally, that is how I would build a portfolio if I were to start a new one today. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and read our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're still watching at this point in the video, you are the real MVPs. Don't forget your peace and thank yous.